Most people think they understand what just happened in the silver market. They don't. They saw the crash. They saw the rebound. They think it was chaos. It wasn't. What you witnessed over the last 48 hours was not a failed rally, a broken bull market, or random volatility. It was a controlled stress test, run by institutions that needed one thing before the year truly began: liquidity. Silver didn't collapse, it was pushed. Silver didn't recover, it was released. And if you reacted emotionally to either move, the system worked exactly as designed. This briefing is not about predicting tomorrow's price. It's about understanding why the market behaved this way, who benefited, and why this violence had to happen before the real move can begin. Because the trap is already sprung. The question is whether you were inside it. The whipsaw was not volatility, it was extraction. The crash and the rebound were not separate stories. They were a single operation executed in sequence. The down move created the conditions the up move required. The up move validated the purpose of the down move. This is how engineered markets behave when they need liquidity more than they need direction. Rapid swings like this are not designed to discover price. They are designed to force decisions. They compress time, compress patience, and compress discipline until participants act against their own interests. A slow market allows reflection. A violent market forces reaction. Reaction creates flow, and flow is what larger players need when positioning has to be rebuilt and books have to be cleaned. The evidence is always visible in the behavior it produces. At the lows, retail capitulates. Positions are dumped under pressure because the price action feels final and humiliating. At the highs, retail re-enters. The same traders who sold into fear return under urgency because the rebound feels like confirmation they are late. The transfer is consistent. Fear sells low. Relief buys high. Both decisions feed the same machine. This is not an accident of emotion. It is the extraction mechanism. The market does not need everyone to be wrong. It only needs enough participants to act quickly and predictably. Panic liquidations create forced selling. Relief buying creates poor entries. Both sides supply liquidity at the worst moment for them and the best moment for the other side. Anyone trading directionally inside this kind of range is feeding liquidity to larger players. The market takes the premium from impatience and pays it to those who can wait. In this environment, the first objective is not performance. The first objective is survival. The whipsaw is a filter. It removes leverage, removes weak conviction, and removes anyone who needs certainty before holding a position. That is what this price action is doing. It is not showing confusion. It is proving control. It is shaking the board until the pieces that cannot endure volatility are gone. The extraction is not a side effect. It is the point. The calendar turn ended. Forced selling, not the bull market. The selling that defined the final days of December was not discretionary. It was procedural. Large institutions were not reacting to price signals or macro deterioration. They were responding to balance sheet constraints imposed by year-end regulation. When the calendar reached its limit, positions had to be reduced. Cash had to be raised. Risk had to be flattened, regardless of conviction. This is how the system behaves at reporting boundaries. The market does not pause for narrative consistency. It enforces compliance. Banks subject to GSIB requirements reduce exposure before the year closes. Assets that are liquid and volatile are used first. Silver sits at the top of that list. It is deep enough to absorb selling and violent enough to scare marginal holders into accelerating the move. The pressure intensified because it was time-bound. Everyone knew the window was closing. That urgency created one-way flow. Selling begat more selling, not because the asset failed, but because the calendar demanded completion. This is why the drop had speed and finality. It was not probing for support. It was clearing inventory. The moment the calendar turned, the condition changed. The regulatory incentive to sell disappeared overnight. The same institutions that were forced sellers days earlier were no longer required to reduce risk. The flow stopped. Not slowed, stopped. That alone is enough to alter price behavior in a thin market. Once the selling pressure vanished, the market did what markets do in the absence of force. Natural buyers returned, not aggressively, not emotionally, methodically. Capital that had waited for the year to reset began to step back in. This is why the rebound was sharp but contained. It was a release, not a chase. This sequence matters because it reframes the entire episode. The decline was not a verdict on silver. It was the cost of compliance. The rebound was not a breakout. It was the normalization of flow. Nothing about this process contradicts a bull market. It confirms that the underlying structure is strong enough to absorb forced liquidation and recover once the pressure is removed. Markets that are fundamentally weak do not snap back when selling ends. They continue lower. What happened here was the opposite. The calendar turned. The selling ended. Price responded immediately. That is not coincidence. It is cause and effect operating exactly as the system is designed to operate. Why silver looked insane while gold stayed calm. The divergence between silver and gold during this period was not a contradiction, it was a confirmation. Gold and silver do not serve the same function inside the monetary system, even though they move in the same direction over time. Gold is the anchor, silver is the amplifier. When stress enters the system, gold absorbs it, silver expresses it. Gold remained stable because the macro signal never broke. Central banks, sovereign funds, and long-cycle capital did not exit gold. They did not reduce exposure, they did not signal concern. Gold held its structure because the monetary thesis remained intact. Inflation risk, currency debasement, and geopolitical uncertainty did not disappear during this window. They intensified. Gold reflected that continuity. Silver behaved differently because it sits at the intersection of monetary metal and industrial input. It trades in a thinner market. It responds more violently to marginal flows. When liquidity is low and forced selling enters the system, silver moves further and faster than gold. This is not dysfunction. It is leverage embedded in the asset itself. Holiday conditions amplified this effect. With many desks understaffed and volume suppressed, price discovery deteriorates. In that environment, relatively small orders can move the market aggressively. A single institutional sell program can push silver several dollars lower. A single wave of buying can reverse it just as quickly. This does not mean conviction has changed. It means participation is temporarily distorted. Gold's behavior during this phase is the key signal. If gold had broken structure, failed support, or cascaded lower, the silver move would have carried different meaning. That did not happen. Gold consolidated near its highs. It absorbed volatility without surrendering trend. That tells you the system's core demand remained intact. Silver's volatility then becomes noise layered on top of a stable signal. It overreacts on the downside when fear enters. It overreacts on the upside when pressure is released. This is how silver has always behaved in bull markets. It punishes weak hands early and rewards patience later. The takeaway is structural, not emotional. The chaos in silver does not negate the macro environment. It expresses it. Gold's stability confirms the monetary backdrop. Silver's instability reflects temporary flow distortions and positioning battles. Together, they describe a system under stress, not a thesis under threat. When the anchor holds and the amplifier swings, the message is clear. The foundation is firm. The surface is turbulent. Serious capital watches the anchor. Only reactive capital fixates on the noise. The $70 to $75 zone is a kill box, not a trading range. The price zone between 70 and 75 is not neutral territory. It is not a range meant for discovery or balance. It is a containment zone designed to extract capital from anyone attempting to force certainty where none is being offered. This band exists to exhaust participants, not to reward them. When price oscillates violently inside a clearly defined range, the objective is not progress. The objective is attrition. Every rally invites premature optimism. Every pullback invites premature fear. Both reactions produce orders. Those orders are not signals of conviction. They are signals of impatience, and impatience is the raw material this zone consumes. Algorithms dominate this environment. They are programmed to exploit predictable behavior inside compression ranges. They fade strength and punish weakness. They do not care about direction, they care about flow. The middle of the range is where that flow is richest, because it captures both sides repeatedly. This is where retail traders are most active and least protected. True trends do not begin in the center of a box. They begin at the edges, after imbalance has been resolved. Inside the box, price action is intentionally confusing. Momentum indicators fail, breakouts reverse, support and resistance blur. This is not poor market structure, it is deliberate structure designed to shake out anyone who cannot wait. Capital that survives this phase does so by refusing to engage. Waiting is not passivity here, it is defense. Every attempt to trade directionally inside this zone increases exposure to noise while offering no asymmetrical reward. The risk is immediate. The payoff is uncertain. That is not an investment environment. It is a toll booth. The system is performing a sorting function. It is separating participants by time horizon. Short-term capital is being recycled. Leverage positions are being forced out. Long-term capital is standing aside, observing, allowing the process to complete. This is how clean trends are prepared. Disorder comes first. Exhaustion follows. Clarity arrives last. The longer price remains trapped between these levels, the more effective the extraction becomes. Confidence erodes, narratives multiply, traders overtrade, positioning thins. When the break finally comes, it will not reward those who fought inside the zone. It will reward those who preserved capital and conviction while the zone did its work. This is not a market failing to move. It is a market preparing to move by eliminating interference. The kill box exists to ensure that when direction asserts itself, there are fewer weak positions left to absorb the force. Those who recognize the zone for what it is stop trying to conquer it. They let it empty itself. Liquidity sweeps. How fear is manufactured on demand. Large buyers cannot accumulate meaningful positions in quiet markets. Size requires liquidity, and liquidity does not appear voluntarily when conviction is high. It must be created. The most efficient way to create it is to force selling from those who are structurally weakest. This is the function of a liquidity sweep. Markets move not on opinion, but on order flow. When a large participant wants to deploy significant capital, they do not chase price. Chasing price raises cost and signals intent. Instead, they locate where sell orders are guaranteed to appear. Those locations are well known. They sit just below obvious support, clustered around stop-loss levels placed by leveraged and short-term traders. The process is mechanical. Price is pushed downward with intent, not force. As it crosses key thresholds, stop-loss orders trigger automatically. These are not discretionary decisions. They are pre-programmed exits. When they activate, selling accelerates. Liquidity floods the book. The market appears to collapse under its own weight, but the selling is artificial in origin. Wednesday's drop followed this exact pattern. Support levels were breached in sequence. Stops were triggered in waves. Fear spread rapidly because the move felt sudden and uncontrolled. That perception is part of the mechanism. Emotional contagion increases participation. More sellers appear. The book fills. Liquidity is achieved. Once the required volume is absorbed, the behavior changes instantly. The forced selling ends because it has completed its purpose. There is no longer a need to push price lower. The same participants who absorbed the panic now step back. With the artificial pressure removed, price rebounds. The snapback feels violent because the prior move was unnatural. This is not a malfunction of the market, it is a feature. Liquidity sweeps allow large capital to reposition without paying a premium. They transfer assets from weak hands to strong hands under conditions of maximum stress. Fear is not incidental. It is the tool that makes the transfer possible. Retail participants often interpret these events as betrayal or manipulation because they experience only the outcome, not the intent. They see price fall through levels that felt secure. They sell to protect capital. They then watch price recover without them. The sequence feels personal. It is not. It is structural. The sweep is over when the selling pressure disappears as quickly as it arrived. That disappearance is the signal. It tells you the objective has been met. Liquidity has been harvested. Positioning has shifted. What follows is not driven by panic, but by the absence of it. Understanding this process changes how volatility is perceived. The drop was not evidence of rejection. It was evidence of demand operating below the surface. Fear was manufactured because fear produces supply. Once that supply was collected, the market moved on. That is how accumulation is executed in plain sight. This is why physical holders should not anchor to spot volatility. The signal is not in the chart. It is in the behavior of those who actually move metal. During this episode, they held firm. That tells you demand did not blink. Only paper did. When paper collapses and physical stands still, the implication is simple. Value did not fall. Confidence did. Once leverage is cleared and fear dissipates, paper prices are forced to reconcile with physical reality. That reconciliation always happens upward, not downward. Mining stocks are lagging because uncertainty is temporary. The underperformance of mining equities during this period is not a contradiction to the metal's strength. It is a direct consequence of volatility. Equity markets do not price chaos well. They retreat from it. When input prices swing violently, valuation models break down, and capital steps back. Mining stocks are businesses before they are leverage on metal. Analysts and portfolio managers require stable assumptions to commit capital. When silver moves $8 in a day, forward earnings estimates lose credibility. Cash flow projections widen, risk premiums expand. The easiest response for equity investors is to reduce exposure until clarity returns. This behavior is mechanical. It has nothing to do with deteriorating fundamentals. In fact, the opposite is true. At $70 silver, most primary and secondary producers are operating with extraordinary margins. Costs have not risen anywhere near as fast as price. Balance sheets are improving. Free cash flow is expanding. The business case is stronger than it was at lower prices. The disconnect exists because the market is temporarily mispricing certainty. Equity investors are still anchoring to prior regimes where silver at much lower levels defined the base case. That anchor has not yet reset. The recent volatility delays that reset by obscuring the new normal. $70 is no longer psychological. It is structural. The level at 70 is no longer a sentiment marker. It is no longer a number traders debate or negotiate with. It has transitioned into structure. Markets treat structural levels differently because they are defended by capital that does not respond to noise. This transition happens through polarity. What once acted as resistance becomes support once it is decisively cleared. That shift is not symbolic. It reflects a change in who is active at that price. When silver broke above 70 previously, it forced sellers to retreat and invited new classes of buyers. That altered the composition of the order book permanently. The test of any structural level is not whether it is touched, but how it responds under stress. When price was driven back towards 70, it did not drift there naturally. It was forced there through a liquidity event. The intent was to break the floor. The result was the opposite. Price held. That response is the definition of structural support. At that level, buying did not come from retail confidence. Retail typically sells into fear at round numbers. The bids that absorbed supply at 70 were not emotional. They were passive, large, and persistent. That profile belongs to institutions, industrial users, and long-duration capital. These participants do not chase momentum. They define floors. This is why 70 matters. It represents a price where demand overwhelms forced supply. As long as that condition holds, the path of least resistance remains upward, even if the journey is violent. Structural floors do not prevent volatility above them. They prevent collapse below them. The risk framework becomes clear once structure is established. Above 70, volatility is tolerable. It is noise around accumulation. Below 70, the thesis changes. That line is not arbitrary. It is where capital has shown its hand. It is where buyers have demonstrated willingness to absorb stress. Markets reveal truth through behavior, not commentary. The behavior at 70 revealed commitment. Sellers tried to push through it and failed. That failure is information. It tells you more about future probabilities than any forecast. This is how bull markets mature. Early phases are chaotic because structure is being built. Floors are tested aggressively because large players need certainty before committing scale. Once those tests are absorbed, volatility does not disappear, but it becomes directional over time. 70 is no longer a number people talk about. It is a level the market has already voted on. That vote was cast under pressure. It held. From this point forward, that level functions as a reference for strength, not fear. Paper chaos versus physical reality. The violence in the paper price did not transmit to the physical market. That divergence is not subtle, and it is not accidental. It is the clearest signal in the entire episode. When paper markets detach from physical behavior, price action stops being a measure of value and becomes a measure of positioning stress. Spot prices moved aggressively because paper contracts can be created, sold, and liquidated without reference to inventory. Futures and derivatives respond instantly to leverage, margin requirements, and algorithmic pressure. They are efficient vehicles for forcing behavior. Physical metal is not. It moves slowly because it is constrained by supply, logistics, and real demand. During the drop, physical dealers did not capitulate. Premiums did not collapse. Inventory was not dumped. In many cases, premiums widened as spot fell. That response matters. Dealers live inside the flow of real metal. They see orders, withdrawals, and shortages before anyone else. When they refuse to lower prices during a paper sell-off, they are signaling disbelief. The physical market treated the drop as transient. It did not validate it. That tells you the selling was not driven by end-user demand or surplus inventory. It was driven by paper positioning. The street understood this immediately. Physical holders were not offered bargains. They were offered excuses. The metal did not change hands cheaply because it was not actually abundant. This is how disconnects form. Paper markets can trade fear endlessly as long as contracts can be settled financially. Physical markets cannot. They clear only when metal moves. When the two diverge, the paper price loses authority. It becomes a tool for clearing leverage, not a reflection of scarcity. These moments expose the hierarchy of truth. Paper sets headlines, physical sets reality. When the two conflict, reality wins over time. Dealers defending price are not speculating. They are protecting inventory in a market where replacement risk is rising. They know that selling cheaply today means failing to restock tomorrow. This creates lag, not failure. Historically, mining equities always trail during periods of violent price discovery. They move last because they require confirmation. Once metal prices stabilize above new structural levels, the math becomes unavoidable. Valuation compressions correct rapidly when earnings visibility improves. The current hesitation is therefore an opportunity created by process, not risk. The market is pricing miners as if the recent drop represents potential collapse. It does not. The downside scenario is now the structural floor. At that floor, producers remain highly profitable. That asymmetry is not yet reflected in share prices. When volatility subsides, capital will return with a different mandate. Value investors will run the numbers again. They will see cash flows that dwarf prior cycles. They will see balance sheets de-risking instead of deteriorating. They will see businesses priced as if silver were fragile when it has already demonstrated resilience under stress. Mining equities are a delayed signal, not a broken one. They are waiting for the noise to fade so the signal can assert itself. That has always been the sequence in commodity bull markets. First, the metal establishes structure, then the equities reprice violently. The lag should not be mistaken for doubt. It is the market's inability to process change during turbulence. Once the environment calms, the repricing will not be gradual. It will be abrupt because the fundamentals already exist. The delay is the setup. The whale timeframe and the 2026 exit map large capital does not experience markets the way retail participants do. The difference is not intelligence or access to information. It is time. Whales arbitrage time the same way traders arbitrage price. They buy when others are forced to think short-term and sell when the crowd is trapped in immediacy. Silver's structural deficit does not resolve in weeks or months. It resolves over years. Mines take a decade to permit, finance, and bring into production. Industrial demand does not retreat on volatility. Monetary demand does not reverse because of a calendar event. These realities operate on long cycles. Whales position against those cycles, not against daily candles. This is why violent drawdowns do not register as danger to long-duration capital. They register as opportunity. When price collapses on forced selling, whales are not reacting to the chart. They are responding to supply being offered at scale under duress. They understand that impatience creates discounts, and that time converts discounts into asymmetry. The retail mistake is horizon compression. Short-term volatility is mistaken for information. It is not. It is noise generated by leverage, liquidity constraints, and behavioral pressure. Whales extend the horizon until that noise disappears. When viewed over years, the recent violence collapses into a minor fluctuation inside a larger structural move. Exit strategy follows the same logic. Serious capital does not sell based on headlines or nominal price milestones alone. It exits based on relative value and system stress. The primary signal is not the dollar price of silver. It is the relationship between silver and gold. That ratio reflects monetary imbalance more accurately than any single chart. In the early stages of a bull market, ratios remain wide. Silver lags. As the cycle matures, silver accelerates and the ratio compresses. That compression is the exit map. It removes emotion from decision-making. It forces discipline when euphoria is highest. A move toward 85 confirms regime change. It does not trigger exit. Triple digits mark public participation and media saturation. They still do not mark completion. The terminal phase is reached when silver's relative value converges with gold. That is when the system has fully repriced scarcity and monetary risk. The greatest danger in this phase is premature selling. Those who endured the accumulation phase often exit early because volatility conditions them to fear giving back gains. Whales expect that behavior. They rely on it. It is how supply transfers at the top, just as it did at the bottom. The correct posture is not emotional fortitude. It is structural alignment. By anchoring decisions to long-cycle signals instead of short-term stress, capital avoids the most common failure mode of bull markets. Selling too soon is more destructive than holding through volatility. This episode did not weaken the long-term case. It strengthened it by forcing out short-term capital and transferring exposure to longer hands. That is how trends extend. Time, not timing, remains the decisive advantage. Thank you for listening. Based on everything you heard, which side do you think is gaining more ground right now? Share your view in the comments and explain why.